All right, let's go ahead and get started. I want to begin by welcoming you all to the Baker Institute for this conference today. We've got a great list of speakers to address topics that have been raised over the course of a 2-year study. I want to begin first by thanking the sponsor for the conference, which is Chevron Corporation. They were very generous in funding a lot of the work that's been done and participating in the workshops along with our other Energy Forum members of the Center for Energy Studies to sort of vet the work that we've been doing here, looking at, in particular, how commodity price cycles interact with the economy and various other factors. The way the day is structured, you'll actually sort of see a set of themes unfold. So the beginning of the day, we're really going to be talking about more sort of physical market fundamental driven kind of forces to a large extent. And then we'll roll into lunch, and after lunch, we'll begin by hearing our founding director, Ambassador Dridgen, discussing geopolitics in the Middle East and the influences they may have on energy markets as we move forward. Beyond that, we'll actually hear from another component of the study, Mahmoud Al-Gamal, in the afternoon to discuss some very interesting work looking at the cyclicality, in particular in oil markets, and making some statements about where we might go, which I think a lot of you will have a lot of interest in. And then we'll finish the day with a panel discussion around geopolitical influences in various parts of the world that will then, through the course of the moderated discussion, be sort of linked together so that we can actually sort of bring everything back into this sort of holistic global kind of view. Because, of course, as we all know, the oil market is very interconnected. Things that happen in one part of the world will influence everything else. All right, our next speaker is Daniel Ahn. He's currently a visiting scholar at the International Monetary Fund. He as well is well known for a lot of different things. I think the first time I heard him talk was actually about shale. Has done some actually very interesting work, in particular in his role at Citi, where he was previously. But he also holds a position at Council on Foreign Relations, as well as, I think, an adjunct position at Columbia University. So, Daniel, the podium's yours.
Thank you very much for being here. I first would like to extend my thanks to Ken and Amy and to the organizers of this conference, both Melissas, for their hospitality and their support. I'd like to talk about something completely different from everything else that I think is going to be talked about today. Which is namely this emerging new relationship that's appearing between commodities and currencies in the financial market. So let me just start with a chart. If I can get this to work. Oh, there we go. What I have here is a simple correlation chart between DXY, which is a currency benchmark for the US dollar relative to other major currencies, and just WTI, crude oil returns. Notice how, starting from when kind of data exists for WTI up from 1988 to around 2004, there's pretty much no relationship between crude oil prices and currency movements. All of a sudden, in about 2004, the relationship has turned sharply negative. And not only has it turned sharply negative, what you can see is on the right-hand side, there's a slope which determines the strength of the relationship. So, for example, a -1 there would mean that a 10% appreciation of the US dollar would mean a 10%, a 1-to-1 10% depreciation in nominal WTI prices. Now the strength of the relationship is sometimes close to 3. It's a remarkably strong relationship. what's going on? Why all of a sudden, what's so special about 2004 that this has happened? Well, I'm sure some of you may know this famous anecdote about President Reagan and economists. He was so frustrated with economists who kept on saying, well, on the one hand, on the other hand. So he said, just bring me a one-handed economist. Well, if the president said, well, you know, what's going on here, I would say, well, here are 8 hands, 8 possibilities, possible explanations. So first, let me just kind of go through each in turn, and then I'll kind of rewind and look more closely at it. But here are some possible economic relationships that intertie crude oil prices to currency movements. The first and most obvious one is denomination effects. Obviously, crude oil prices are denominated in dollars, and so naturally a swing in the currency and the relative value of the dollar is also going to change the price at which the oil is denominated, simply because it's quoted in dollars. And the causal direction, therefore, would be from dollars to oil. The sign of the relationship would be negative, i.e., a depreciation in the dollar. If the US dollar becomes less valuable, then that would mean the same barrel of crude oil would have to be worth more in dollars. And generally the frequency of this relationship, so the speed in which this effect happens, should, well, in perfectly rational markets, be instantaneous. So there's one explanation. Another explanation is higher US purchasing power. So what I mean by that is an appreciation of the US dollar would mean that the US has more purchasing power to go out and buy stuff, including crude oil. I mean, despite all of the remarkable revolution in shale production, the US is still, at the moment, a net crude oil importer. So there, the sign would be positive. An appreciation of the US dollar would mean more US demand for crude oil, and therefore higher crude oil prices. And I would imagine the frequency, the speed in which that relationship happens is pretty slow. There are things like dollar hedging into real assets. So that would mean that if a dollar depreciates in value, investors who hold a lot of dollar-denominated assets might get concerned, want to try and hedge away from that by investing in real assets. And commodities actually has been one of the most popular asset classes to invest in, to hedge against currency deflation. I have a whole bunch of others. So I'm not going to go through every single one, but the few ones I want to highlight are kind of flight to safety, which basically means, well, if there's some kind of shock to the financial system, there's a crisis of confidence, people often rush into safe assets, of which US Treasuries is probably the gold standard. And so that causes an appreciation in the US dollar. At the same time as, because of all this concern about financial contagion, there's expectations of economic growth decline, and therefore the prices for oil as a benchmark of global economic activity might also fall. So that relationship is negative. It's also what I would call a hidden variable. So it's not that causality is flowing from dollar to oil or vice versa. It's rather there's some underlying factor that's causing both to move in such a way that might drive this co-movement. Let's dig a little deeper into this phenomenon. Let's look here at the same correlation chart, but now instead of using daily returns, I'm looking at weekly returns. You can see that at the weekly level, the relationship is still there. It's not quite as perhaps striking as what we saw in the daily relationship, but indeed the correlations have turned very negative, and their magnitude is pretty significant. But by the time you get to kind of monthly returns, the relationship starts to disappear. It's hard to piece out an interrelationship between the dollar and currency movements once you get to lower frequency. What I also did was I tried to splice in where exactly in the distribution this is happening. So what I've done here is I've taken the same kind of movements between oil and dollar returns, made a scatter chart, and then sort of looked at it by quintile. What's striking is actually the strength of the relationship is really in the tails. So in other words, the reason why this negative correlation between the dollar and currencies has become so strong is happening only in extremes when, for example, the dollar swings by more than 10% and also, crude oil reverses by 10%. It's only in those extremes that this relation seems to be happening. Kind of in the center is just a mess and nothing really is happening at all. So now that we sort of looked deeper at this, what are the possibilities of these possible explanations? What seems to be most consistent with the data? Let's try to do this detective hunt. Well, I'm going to try and gloss over the technicalities, but one way to check is to do what econometricians call the Granger causality test, which is to test for causality between two movements. What's very striking is that the causality seems to be flowing from dollar to oil instead of the other way around. So basically, we can eliminate all other explanations. I mean, not eliminate them, of course, but really focus on just those relationships that seem to be flowing from dollar to oil. And again, denomination effects make sense. But remember, a denomination effect at most is a one-to-one relationship. And of course, in a world where the US is not the dollar is not the only currency, it should actually be a less than one-to-one relationship. In other words, a 10% appreciation in the US dollar may cause a 5% or a 6% depreciation in WTI prices. But as we saw before, the relationship is 3 times as powerful. So it can't just be denomination effects alone. My research suggests that what's actually happening is a combination of denomination effects, which for some curious reason wasn't working before 2004, together with these other things like dollar hedging and flight to safety effects are intertwining into the oil markets. Let me show you another chart. This here is an event study of what happened to various markets right after the major first quantitative easing expansion announcement all the way back in March of 2009. After the Fed made their big announcement that they're going to expand their balance sheet by $1.2 trillion, all the financial markets, of course, reacted strongly. Things like rates, for example, declined very sharply, as naturally as one would expect. The dollar fell, as one would expect. The equity markets kind of drifted higher. But what I found was very striking was that the oil prices were actually among the strongest responders to this announcement of quantitative easing. And so this is a classic data point in that scatter plot that I showed you earlier of an extreme move in the dollar coinciding with an extreme move in crude oil prices. Crude oil seems to be coalescing as a benchmark for global economic activity, for confidence in the financial system, and as a proxy for what financial practitioners call risk-on assets and therefore have this very strong negative relationship between oil and currencies. Another sort of econometric technical test confirmed that something different has changed between the relationship of oil and currencies before and after 2004, as we saw before. Now, why, it's all fine and good to talk about these causal explanations, denominations, flight to safety, risk on, risk off. But what's the actual mechanism by which this is happening? Well, it may be a coincidence or it may not be. But what I have here is a chart showing the daily trading volume in oil futures, paper oil for TI, for Brent, for ICE WTI, versus physical consumption of oil. That black line at the bottom, which you can barely see, is world physical oil consumption, while, say, this dark blue line here is financial trading of paper oil every day. It is orders of magnitude larger than the physical market. And notice it really started to take off around that 2004-2005 timeframe. So it's a brave new world, in my view, for oil, not just because of the shale revolutions that you heard and will continue to hear about, but also because of this new financialization of commodity prices, which has intertwined commodity prices, including crude oil, with other global macro financial factors, such as quantitative easing announcements or the latest unemployment report from the US or news from China. I'd like to conclude with just quick thoughts about how the policymakers are kind of responding to this. As you may know, the CFTC has taken a very activist stance on implementing the new Dodd-Frank rules for commodity markets and other swap and fixed income markets. Probably the single most important thing that they've concentrated on is transparency, to improve an understanding of what exactly is happening and who is holding what in commodity markets. And it's a great, it's great for researchers. I think it is improving the transparency and informative of markets, but I would argue that there's still a little more to go. For example, the CFTC has now released these new what's called disaggregated reports. So it used to be the case that they would show in financial markets for crude oil simply are these commercial operators or non-commercial operators which are holding long or short positions in financial derivatives in crude oil. Now they've divided into 4 categories called producer users or swap dealers and managed money, and the rest are other. What's striking, this is a great first start. What's striking, however, is that you can see while producers kind of take classic long or short positions, the swap dealers in particular hold large amounts of what's called spreading positions or simultaneous long-short positions at different tenors or different price points. And since that's where the vast majority of financial activity is happening, and we don't know exactly what those spreading positions look like, there's still a whole area of financial participation in crude oil markets, which is still ill understood. The other big initiative that US regulators have done on financial markets is centralized clearing. So for those of you who are not familiar with this concept, what used to be the case was that, for example, if firm A, let's call it Lehman Brothers, decided to enter into a swap agreement with firm B, let's say Southwest Airlines, okay, they would essentially literally have a bilateral agreement. They would shake hands, sign a contract for some hedging contract, and Southwest Airlines will be exposed to the credit risk of Lehman Brothers itself. And of course, all of that went horribly wrong in 2008 when Lehman Brothers failed and caused this ripple effect of counterparty credit fear into financial markets that nearly toppled the system. So the CFTC is now mandating that the vast majority of swap activity in crude oil and other commodity markets go through what's called a centralized clearinghouse, which is this institution that kind of sits in the middle between all counterparties and therefore contains the kind of risk in and of itself. And so no firm is ever now directly exposed to the credit risk of another counterparty, but can only do this through a centralized clearinghouse, which has transparency, data reporting, margin and capital requirements, et cetera, that will ensure its safety and therefore not cause risk to spread to any other institution if, say, a firm indeed does fail. So this has tremendous promise in reducing systemic contagion in the financial system. But I'd like to conclude, with the statement that it's not a complete free lunch. It's not like mandating centralized clearing eliminates systemic risk entirely. What it instead does is shift the risk from what I would say is a kind of medium intensity systemic crisis whereby an institution can fail and spread this contagion, and now is all containing all of that systemic risk into one single, far too big to fail institution, namely the clearinghouse itself. And if the clearinghouse itself fails, by virtue of its status as the nexus for all of this transactions, then indeed it will be a crisis of highly intense proportions. So counterparty centralized clearing is indeed shifting what I would say the probability of medium-sized systemic failures downward, which is great for business as usual activity, but is shifting the probability into certainly still very, very small probability, but of a larger size systemic failure. And what regulators need to focus on now is making sure that the clearinghouses themselves are on very sound footing. Okay, with that, thank you very much. I'm happy to answer any questions.
Do you have any questions? Come on, you got it.
Oh,
Yeah, there you go.
So looking at your chart, you're using the Dixie, and that's great. But have you ever looked at using the euro or using the yen as far as the correlation effect on it? Because I mean, every punter out there's got a euro chart up there, and they're trading euro strong, and they're buying the crude, and they're trading it. And you keep going back to 2004. Was 2004 when that starting point turned? With it was. I mean, could it have been like the hedge funds got wise to it and it started, that's how, or Goldman or whoever you want to use, started using this, and that's how that correlation started to trade. And then, because I mean, you look at the risk on or the risk off, and that's been very prevalent, but over this last year, it's really started to break down in a lot of different areas.
Right.
So.
No, that's a great question. I don't have the chart in this presentation, but I have made one for using other currencies, euro and yen specifically. There is hardly any relationship noteworthy. If it happens at all, it seems to be happening through the dollar channel, which is surprising, or perhaps not so much if you still recognize the primacy of the U.S. dollar as the global reserve currency of choice and its benchmark in assessing animal spirits and again, risk on, risk off sentiment. What I expected to see, indeed, very recently, this is not completely up to date. There's now with about 6 months more of extra data, I would have expected to see the relationship weaken in line with these anecdotal talk that risk-on, risk-off sentiment is finally kind of starting to fade, there is a slight diminishment in the strength of the relationship, but not nearly enough so as to say that this new phenomenon is gone away, and also still seems to be far in excess of a magnitude 1 or even 2 event in which it then by itself could be explained by other non-risk-on, risk-off factors like denomination, et cetera. So this still seems to be happening. This has remained surprisingly robust throughout the whiplash crises of 09 and then 012 again. No, this seems to be a phenomenon that's still ill understood, but very much a reality. Yes.
Related to what you just said about benchmark primacy, what would happen if you used Brent instead of WTI in this analysis?
Yeah, the picture doesn't look that different. The reason why I chose TI is, of course, we have a longer history that goes back all the way back to '88. But as you might expect, especially at a daily frequency, Brent price returns and WTI price returns more or less track each other. Recently, as you might suspect, the Brent relationship to dollars is stronger than the TI relationship to the dollar, simply because the DI obviously is now sitting in its own physical isolated pocket and suffering the pressures of storage capacity and pipeline capacity. But nevertheless, this is a daily high-frequency relationship. And so it is very strong for both WTI and for Brent. Yes?
By the time we see the U.S. exporting oil or gas, how does the risk of a Dutch disease comes into the picture with this? Will the rest of the manufacturing or exporting sectors in the U.S. be less susceptible of being affected by this, or we're just going to see a reduction in this? Yeah.
So one of the mechanisms which I didn't mention, but it's on the chart, is you see that current account terms of trade effect. So that is saying the following. Again, given the fact that at the moment the U.S. is still a net crude oil importer, an increase in oil prices would widen the current deficit, the trade deficit of the United States, and therefore higher trade deficits are generally negative to the strength of a currency, because they start thinking, is this a credible country? And so the relationship would be negative, right? A higher oil price would cause a fall in the currency, and the causality would go from oil to the dollar, and it happens at pretty low frequency. I imagine that as the U.S. starts to export crude oil, the picture will start to change, and that relationship will now become a mildly positive one, in which higher oil prices are actually good for the current account of the United States. It's unimaginable to believe, but nevertheless, per your question on Dutch disease, it's a completely different presentation, but I did another study where I looked at the economic effects of the shale boom and the exports of crude oil. As dramatic as the boom is, and it's going to create millions of jobs and add several percentage points to our GDP, it's not the same as the same thing happening to the Netherlands or to a small Middle Eastern country. Our economy seems to be large enough, robust enough, and just simply diverse enough that the phenomenon of Dutch disease, whereby higher oil prices and this natural resource export windfall is going to cause our currency to appreciate so much as to make all of our other exports non-competitive is going to be very, very minimal to this country. Yes.
So the calendar, if I could put that there, the graphs that you showed at the beginning and different ways at the end, and you talked about 2004, and I recall there being very provocative memos, serious memos written about, in other language, about this thing happening initially, and struggling as a fundamental supply-demand guy to understand what was going on. But there was a big, one of the charts, there was a big event or a big period, maybe 2006, early 2007. Am I recalling that right, or you talking? I'm kind of looking for.
Are you looking at this?
For a story, if you were.
He's talking about the financial trading metrics that you showed relative to physical.
Yes.
This
yeah. So I don't know if that's the right way, but I'm really just, as a man in the street kind of thing, asking, what's the story? If you wrote a book for sixth graders, and they probably don't understand higher oil prices, going higher. Well, how would you describe what happened in 2004? What happened in 2006? We know what happened in 2008. We know QE2. But how would you describe that in just very simple?
Yeah, I would describe that as my favorite phrase is commodity markets emerging into adolescence.
Sixth graders.
Yeah, for sixth graders, so they know what's going on. Basically, commodity markets until sort of 04, 06 was, of course, physically a very robust market, and in fact, for those of you who might know your history, commodity markets were the oldest financial market, but nevertheless had remained very much a backwater, if you will, until quite recently. And then quite recently, around that 04, 06 range, they started to explode in interest, in liquidity, in size, and in sophistication. And why that happened is perhaps a different story, but I think it's not unrelated to the fact that they were going up and up and up, and was also a reflection of what was happening in China, which was, the single most exciting growth story, and probably still is today. But there was no way for financial investors to get direct access to China, a few small pockets aside, and therefore commodities served as this kind of indirect back channel way of buying into the China story. But the reason why it says it's in its adolescence is that it's no longer in its infancy. It's a multi-billion-dollar market now, but it's not in its maturity of where all of these weird kinks have been worked out and where it's now fully understood, and now there still isn't sources of, say, arbitrage still left to be weeded out, but as a sign of its adolescence and its growing importance as affecting the global economy and being affected by the global economy, oil prices, which used to be set by physical oil watchers. When I first arrived in the financial markets expecting to do this, I expected just to be counting barrels like everyone else. And then guess what? All of these new factors started going in to the question of what determines crude oil prices. And so, again, it's entering its adolescence, whereby all of these different factors that used to not really affect just a kind of separate and isolated market for crude oil now started to do so. And it's actually, interestingly, the physical people who have started to try and respond to this. I mean, it used to be, oh, you just count the barrels of oil, count your inventories. If inventories are high, then it sort of does this. If it's low, it does this. Now they need to start understanding quantitative easing. They need to start understanding what's happening, with the Eurozone crisis, even though it may have no direct impact on their physical balances. So again, it's a brave new world for commodities in multiple respects. But I think this interrelationship with currencies is another sign of that. I believe there was another question up here somewhere.
I had a very similar question. I was just curious what you were feeding that sixth grader to turn into an adolescent. And the China example was one good part of the story that I hadn't connected the dots to. So same question.
Right.
Yeah, it's 2004. It's why it's a change. It's I think so. Two things. One thing is commodity is changing goods. It's this means investing purpose. Second is dollar and for example is and we are enjoy fashion. It's a carry trade. It's a low volatility. It's a this is might be a hint. It's my question is this correlation is influenced by Fed policy. It's a monetary policy. When had to finish the QE3, it's what do you think about? Can you anticipate the correlation, relationship between crude oil price and dollar index?
Right. I think I'll try and. I think there are two questions in there, and I'll try to answer the second one first. What could be the potential impact of an unwinding of QE3? Well, you take this research literally, and what it means is a retrenchment in QE3 is going to probably strengthen the U.S. dollar, and therefore cause a dip in nominal crude oil prices. My sense, however, is that that might be mitigated by a couple of things. It first might be mitigated from the sense that while in isolation, all else equal, a diminishment or retrenchment of QE3 is going to strengthen, strengthen the U.S. dollar. It also will happen in a context in which obviously the U.S. economy is stronger. I mean, Bernanke has made it very clear that that his unwinding of QE3 is conditional upon the strength of real activity and the strength of the labor market. And so if this is happening in a time when the U.S. economy is sort of really back on its feet, and presumably back on its feet enough so that maybe financial markets are also, calm and not ready to rush back to U.S. Treasuries all over again. This might actually be coinciding with related, although separate, weakening of the U.S. dollar as a reflection of increasing, risk-on activity and positive investor sentiment in other asset classes. So you can start to see how you really go in circles. There's an immense amount of causal loops and chains to be disentangled, which I think is partially why this phenomenon is still not quite understood. But nevertheless, I would say that benchmark the effect would be negative for crude oil prices, but only in the short term. Again, this is a phenomenon that's happening that starts to weaken by the time you get the monthly frequency, and therefore it probably will have no effect, gladly for economists, in the longer term. I believe there's one other question. Yes.
Yeah, I was just curious, since 2004, especially right now that Dodd-Frank's come in effect, we've seen the reduction of exposure from a lot of banks and long-term trend following hedge funds. Do you think we could see a reversal of financialization?
A reversal of financialization. Now that's a very good question then. every bank is asking themselves right now. My sense is the following. My sense is that you won't see a reversal. This is just my own completely subjective opinion. My sense is that you won't see a reversal of financialization, but again, in the story of adolescence, of maturation, there simply won't be as much rents. I don't know another way to put it. Rents and premium that market makers and brokers like banks can extract from the industry. As things like ETFs proliferate, as more and more sophisticated financial products are provided in an increasingly saturated and competitive market for commodity and every other financial product, I expect that trading activity will continue, but perhaps the profits to the banks won't be as large, and therefore there won't be as much, perhaps, excitement around it as usual. I have a report that I wrote for the Council on Foreign Relations, in which I made kind of recommendations on regulating the energy market, and I drew a lot of analogies to the corporate bond market. The corporate bond market is another market that's gone now in full maturity. It is a very liquid, very robust, very sound market. Any company can go out and tap into very deep capital pools by raising bonds, but it's a sleepy backwater for banks because it's difficult to extract profit because the market is efficient. So I think the market for commodities, as it grows more efficient, is going to look more and more like the corporate bond market. More efficient, more liquid, ideally of more use and more closely linked to the real economy, but perhaps less of an exciting place, perhaps, for market makers and speculators. One other question, I think, in the back. Yes.
You picked a 12-month period for the rolling correlation. Is there any specific reason why you picked 12 months and not something different?
No, I mean the simple reason is because you can see the effect happening. I mean, if you look at it at slower frequencies, I mean, at shorter time frames, the effect is all over the place. While if it's, I mean, the effect is there, but if you look at it at longer windows, then you start to, it starts to smooth out naturally. So 12 months, but the picture's more or less the same whether you look at 6 months, 12 months, 24 months. It seems to be living kind of in that frequency, though.
Now, do you think that you will use I mean, what kind of rolling window, if it matters at all to you, that will you use to test if that relationship is breaking? Because post-2004, recently, if you were going to look for a lean indicator or something like that, or how would you test for a break in that relationship, a change?
Well, what I would do is to go back to, I didn't want to get into the technicals, but I mentioned earlier these statistical tools by which one can test for breaks in a relationship. And indeed, this confirmed a break in the relationship before and after 2004.
Right, but like I said, the test that you use, you need to know exactly when it breaks, right? So there's different.
I'm sorry, you need to know what?
You need to know the period in which you're going to be testing when exactly the break happens, right? So like I said, you can use different tools, right, to test whether or not you have a break in a period that you don't know exactly when it is.
I mean, this is where it becomes an art and not a science. I mean, I know people who brute force the approach, literally test for structural breaks at every single possible time point in their sample and see where the significance is highest. But that smells strongly of data mining to me.
No, this was developed by Bruce Hansen and Chu back in the 1990s. to do the distribution of
Yes,
funds.
yes. I mean, it's a powerful tool, but it's powerful sort of in the right hands and in the right circumstances. I like to have it at least reflect some more eyeball kind of intuition. And as we saw before, that sort of seemed to start to happen around 04. I did a test around 04, found that there was a structural break. I sort of tested to see whether its effect is stronger at 03 or 05 or 06. 04 seems to be around that sweet spot. Now, why is there a break between that versus this, where the effect seems to be happening around 06? My own theory is that it's because this is for observable futures markets, while of course there's a whole other opaque swap market, which started to take off in 04 anecdotally before the futures started to catch up. So really what was happening, if I could have a chart like this for the swap market, I would suspect that I would see it, the break in 04. But nevertheless, I think it's interrelated, and it's not like the effect. I mean, we keep on saying 04, but it's not like this was a kind of one-to-one step either. You can sort of see in 04 was when it started to break out of that window, but it was only in 06, 07 that it started to shear down further beyond that window into the pretty strong relationship it has right now. So, I mean, we can.
Context, not that, I know that the financial markets move differently, but on the oil side, if you think about it, 03 was the Venezuelan oil strike, which put the mindset in the oil market really squarely on peak oil, on that, Venezuela was going to not be producing and everybody was not going to be producing, and I call it like the Matt Simmons effect in honor of Matt. It was like the whole mania about we're running out of oil started after the Venezuelan strike, which was 03. So I'm sure there might be other technical reasons in the financial markets and everything, but from the oil perspective, I think 03 was a turning point. The way people, and you had the invasion of Iraq, that's right, that also made prices go up on the Middle East side. So that's exactly right. You have two major geopolitical events in 03, which then spilled into speculative fervor in 04.
There was actually another issue that I think, just think back a decade, right? The end of 2000 was Clinton's exiting office. He signed into law the Commodity Futures Modernization Act. And right on the heels of that, it changed the way you traded electronically, basically. But right on the heels of that, you went into the merchant energy demise. And that's really where all of the trading, sat at that point. So I look at this chart and I see it's really about unwinding those books and then the banks taking off. So
one more while we're at it, that was the period of the great moderation. Hedge fund managers were looking somewhere where they can generate 10% plus, and commodities was the only thing moving.
And finally, getting back to the China story, this was also the time when China was really starting to take off.
I did some work on barrels, on oil demand, looking at oil demand and GDP using various things. And one of the just very odd things, without any statistical tools really, but is the fact that GDP in a whole range of countries just popped way, way high in oil demand in 2004. That was the calendar year. And it sticks out in the way that you talked about looking at structural changes.
Right.
I always wondered what that was.
Right.
I assumed there were trading relationships that connected China to other parts of the world, but it would also point one back to the way you answered initially, is this a China story may be very important.
Absolutely. I actually have a question. If you go back to the chart that showed the financial activity and this coincides, in my mind, very well with injection of liquidity by the U.S. Central Bank into the market. And the question I have, and it relates back to that relationship that you showed in the previous chart, but if that liquidity starts to be extracted, do you think this relationship could eventually unwind?
Right. So my initial hunch, again, it was that the effect would weaken strongly in the past several months. I mean, obviously, QE3 is still going strong, but the sentiment has already started to shift against it. And I'm left with the frustratingly ambiguous answer that it has weakened, but only slightly. So is it simply just noise, or is it the first signs that something is starting to happen, the effect is starting to weaken? I don't know. The other frustrating thing to try and pinpoint an explanation is, again, we can talk about China, we can talk about Venezuela, we can talk about all these other things, and all of them seem like plausible explanations for this structural break. I'm sure if you sort of combine them all together, they explain the break and more. But why didn't they affect back in the 80s and 90s, right? I mean, it's not like things were happening then as well, right? I mean, it was probably sort of the tail end, obviously, but the tail end of another kind of heavy infrastructure-related boom in East Asia, right? With the four tigers kind of taking off and all of that. I mean, was it simply because the world was so awash with oil after the breakage of OPEC unity that oil markets sort of decided to do their own thing, regardless of what was happening to kind of broader macro trends and so on? It just seems very puzzling to me. Let's just say it, that you know, in a time period when the dollar had its own massive pressures, you know, James Baker's meeting at I forget which hotel, at the Plaza Hotel, the Plaza Accord to kind of reflate the yen and all that stuff. Why did it not have an effect on oil prices? Or maybe it did, but the effect was slow and therefore didn't show up in this high frequency thing? I don't know. But something was in the water in that period of around maybe 02, 03 up to 07 that started to change. And now, despite all of the, despite the possibility that all of this will unwind, the effect still seems to be very strong. And my own intuition tells me that it might weaken a little bit from its extremes in 010 and 012, but it will still be a phenomenon that's here to stay.
Any other questions? Thank you, Dan.
Thank you.
Okay, so those two talks set the stage greatly for, just incredibly well for what we're going to do after the coffee break. I'm going to hopefully address some of the questions in a different way that were raised, in particular around how you tie physical to financial and sort of bring all these under one umbrella and think about oil prices as going forward, as we're going to need to, because I certainly agree with the premise based on the research that I've done that Daniel presented. We are in a different paradigm. And a lot of that is driven by physical aspects of the marketplace, but it also is undeniable that there's greater financial pressures exerted on oil prices. So with that, let's go ahead and break for coffee, and we'll meet back in just a little bit.